Essential Alternatives is your exclusive gateway to information and investment ideas. Register now at ausbiz.co/alternatives. This event is thanks to presenting partner LGT Cresto. Access unique opportunities and expert advice to build wealth for generations.
Let's get into the advisory. And why should you be looking to invest in the first place? And how can you devise a strategy best suited for your goals? Cameron Curko from Pitcher Partners joins me. And we just heard there from the MD of Pinnacle, Cameron, saying it is always better to be invested in the long term than just keeping your money in cash.
Yep. And Ian's spot on, right? Like, markets tend to reward us over the long term. And look, we get this question all the time from clients. So, I've got a pile of money. Should I dollar cost average or just invest it today? Typically, psychologically, you go, okay, dollar cost average. Technically, if you actually look over time, it's better to just be invested, echoing what Ian said. And like, really, what I wanted to discuss today was to talk about, why you invest in to begin with. And I think that's often not what people actually ask themselves enough. They just see some bright, shiny toy and like, I want to earn a slice of that, which, if you're investing for fun is fine, but like, you can have other goals and you can really build for the long term. Like Ian was talking about Pinnacle there, just, if you bought shares when it first listed, the dividend payment now is almost your cost basis of those shares, which is insane. But it's also a testament to, if you hold for the long term, just how rewarding it can be.
Yeah, although you then can potentially face concerns like capital gains tax. So what are some of the other advice, or what is some of the other advice you give people? And I guess it depends on your goal, right? Is it a short term for a holiday? Is it long term for retirement?
Yeah, absolutely. So look, you don't need to overcomplicate your life. Like, if you've got something where you're saving some money for, say, a holiday at the end of the year, you don't want to play with the shares in that case. Just cash and low risk solutions work. But if you've got something much longer term, say, look, you're saving for another property 5-10 years down the track, or retirement, that's where some of these longer duration assets, such as shares, such as property and the like, can actually come into play as a way to generate growth that you need for those longer term goals. So it's really a question of, what is your time horizon, and being really clear and honest with yourself. Like, you want to maximize the likelihood of actually succeeding, and you don't need to take excessive risk. And I think that's actually one of the takeaways more people should have. Like, if just sitting in cash and just adding a little bit over time is enough, then that's fine. But if you do need to get more meaningful growth, then you should also be honest with yourself about that. And the other thing people don't often do enough is just put it in writing. I think those are some of the common mistakes, and there's a slew of others that we can touch on as well.
Yeah, maybe a gratitude journal, write down your goals. You're talking here about some of the warnings, though, like don't double up on exposures, avoid thematic plays. Can you just go into that a little bit more?
Sure. So I think with that, and I was listening to a separate investment podcast the other night, and the guys were talking about, I had, for example, IOO and VTS exposure. And for those that don't know, IOO invests in the biggest US index, the S&P 500. VTS invests in a US, what's called a total market index, so includes some small cap exposure. And the point I was trying to make there is, functionally, you've got, say, 85% of the exact same stocks that you're holding. And all you're doing in that scenario is just increasing your trading costs. So that's just one example where you really want to think long and hard about what you're actually investing in, and just making sure it's the right kind of exposure. With thematics, like, again, I was talking about shiny new toys. So, someone might think, agriculture is a really hot space right now, and I want to invest in that, or some kind of commodity. Crypto is another one as well. The problem with these thematics is you as an investor should really take a step back and think, why was this thing even launched? Like Wall Street or financial markets in general are very good at, selling snow to Eskimos or giving people what they want. And that's not necessarily what's right for you. Like, I think sometimes people really struggle with their motivation. Like, if you want to have a bit of fun and say, oh, look, I have cyber security exposure because I think that's a hot space, then, that's fine. But if you're investing a meaningful proportion of your savings, that's where you've got to be a lot more careful. And what you typically find with these thematics is a lot of them typically are riding momentum. So they have a good initial run and then they die on the vine. And, maybe 5 years down the track, they come back.
Well, Cameron,
You can see that in the actual assets.
we are losing your connection a little bit, but I hope we can get you for this last question, just about what stocks you're looking at in terms of, might do well in reporting season. I know ResMed is one, and obviously it's done very well, but what else are you looking at?
Yeah. I think what we're really looking at is just seeing how the healthcare names in general play. Like, I think particularly CSL, that's been really downtrodden stock for the last couple of years, really, and broader healthcare as well. Like Cochlear is another one of those sort of long-term quality names. I think in terms of that list you've got up there, Ansell, I think it's just going to be really interesting to see how they're navigating some of the tariff challenges, because out of that entire list, they're arguably one of the most exposed. CSL at least has the option of onshoring some of its production into the US, and also ideally Australia has more favourable tariff rates that we face. So I think really that sort of global backdrop, what the Trump administration is doing on healthcare is really causing a bit of havoc, and like your global healthcare index has been struggling materially over the last year. So I think healthcare is definitely one space, and also just some of those growth stalwarts. So your WiseTechs, your Xeros, just to see how some of those are tracking. So Xero's already reported, but WiseTech will be one example we're watching closely, just because you do have some pretty lofty expectations there.